Official U.S. economic data still signals resilience, yet behavior across labor markets, consumers, and corporations tells a different story. Spending patterns are tightening, hiring is slowing beneath the surface, and credit stress is rising in places not captured by headline indicators. This gap between reported strength and lived economic reality matters now because policy, markets, and households rely on the same data to make forward-looking decisions. When the signals are distorted, responses arrive late or miscalibrated. The danger is not a sudden collapse, but a prolonged period of misinterpretation where risks accumulate quietly. A recession does not require negative headlines to exist. It only requires sustained deterioration in income security, demand, and confidence. What makes the current moment unstable is that the tools used to diagnose economic health are increasingly backward-looking, while the stress is already moving forward through the system. Headline economic indicators in the United States are increasingly presenting a picture of stability that does not align with the underlying condition of the labor market and household income dynamics. This divergence is not accidental, nor is it the result of data manipulation, but rather a structural limitation of how economic strength is conventionally measured. Employment reports prioritize headline job counts and unemployment rates, metrics that are effective at capturing turning points only after they have already occurred. In the current environment, these indicators are lagging a deterioration that is already embedded in the quality, durability, and purchasing power of employment across large segments of the workforce. The result is an extended period in which official data suggests resilience, while economic stress quietly accumulates beneath the surface. The most visible distortion emerges from the emphasis on aggregate job creation without sufficient weighting for job composition. Recent employment gains are disproportionately concentrated in lower-wage service sectors, part-time positions, and roles with limited benefits or schedule stability. Full-time employment growth has decelerated markedly, even as total employment figures continue to rise. This shift matters because full-time positions historically provide the income stability necessary to support discretionary spending, long-term financial planning, and household balance sheet health. When employment growth is driven by roles that lack these characteristics, the headline numbers lose their predictive value for consumer demand. The economy appears to be adding jobs, yet the capacity of those jobs to sustain spending is materially weaker than in prior cycles. At the same time, average hours worked have stagnated or declined in several key sectors, a signal that firms are managing labor costs cautiously in anticipation of softer demand. Employers often reduce hours before reducing headcount, making this a leading indicator of labor market stress. However, hours worked receive far less attention in public discourse than payroll counts. A workforce that is technically employed but working fewer hours experiences an immediate income impact that does not register as unemployment. This dynamic contributes to a widening gap between employment statistics and lived economic conditions, particularly for households that rely on hourly wages and variable schedules. Wage growth, while still positive in nominal terms, is failing to keep pace with the cost structure facing households. Essential expenses such as housing, insurance, healthcare, transportation, and food have experienced persistent price pressures that outstrip wage gains for a significant portion of the labor force. Real wage growth, when adjusted for these costs rather than headline inflation averages, has been flat to negative for many workers. This erosion of purchasing power is not evenly distributed. It is most pronounced among middle and lower income households, which also exhibit the highest marginal propensity to consume. As their real incomes weaken, the impact on aggregate demand becomes inevitable, even if it is temporarily obscured by other factors. One of the clearest signs of labor market strain is the rise in multiple job holding. An increasing number of workers are taking on second or third jobs, not to increase discretionary income but to offset the inadequacy of primary wages. Multiple job holding inflates employment figures while masking income insecurity. A worker holding two part-time jobs is counted twice in payroll data, despite experiencing greater financial fragility than a single full-time worker. This statistical artifact creates an illusion of labor market strength precisely when income stress is intensifying. It also introduces exhaustion and productivity constraints that further undermine economic resilience over time. Labor force participation improvements have similarly contributed to flattering headline unemployment rates without resolving underlying underemployment. While higher participation is often interpreted as a sign of economic health, in the current context it reflects necessity as much as opportunity. Individuals re-entering the labor force to cope with rising living costs may accept lower quality or mismatched jobs, increasing labor supply without commensurate improvements in income security. Underemployment, defined by skills mismatch, involuntary part-time work, or insufficient hours, is rising even as unemployment remains low. This divergence weakens the signal value of traditional labor metrics and delays recognition of demand-side fragility. Disposable income growth is the critical variable connecting labor market conditions to macroeconomic performance, and it is here that the consequences of these distortions become most apparent. After adjusting for inflation and rising non-discretionary expenses, disposable income growth has slowed materially. Households are increasingly constrained in their ability to fund consumption through earnings alone. Because consumer spending accounts for a majority of U.S. economic activity, this shift has systemic implications. An economy can appear stable as long as spending holds up, but the source of that spending determines its durability. As real income growth weakens, households turn to credit to maintain prior consumption levels. This transition from income-funded to debt-funded spending is a hallmark of late-cycle dynamics. Credit cards, personal loans, and short-term financing instruments become substitutes for wage growth, supporting headline consumption figures while increasing future vulnerability. This behavior is rational at the household level but destabilizing at the macro level. Debt-funded consumption pulls demand forward, creating the appearance of stability today at the expense of tomorrow's spending capacity. Official economic data captures the spending, not the fragility embedded in how it is financed. The reliance on credit also introduces nonlinear risk. Once households reach borrowing limits or face tighter lending standards, consumption can contract abruptly rather than gradually. Because this adjustment occurs after prolonged misinterpretation of economic strength, policy responses are often delayed or miscalibrated. By the time declining demand becomes visible in retail sales or GDP data, household balance sheets are already strained, limiting the effectiveness of stimulus measures. This lag is a direct consequence of data frameworks that prioritize employment quantity over income quality. Another critical dimension often overlooked in headline indicators is income volatility. Even when average wages appear stable, variability in hours, scheduling, and gig-based work increases uncertainty for households. Income volatility suppresses discretionary spending and raises precautionary savings behavior among those who can afford it, while forcing those who cannot to rely more heavily on credit. Both outcomes dampen sustainable demand growth. Traditional metrics do not adequately capture this volatility, further widening the gap between reported economic health and underlying conditions. The cumulative effect of these labor market distortions is a delayed recognition of recessionary dynamics. Economic contractions are not defined solely by job losses, but by sustained declines in real income, purchasing power, and confidence. When data systems are slow to register these changes, markets and policymakers remain anchored to outdated narratives. Financial markets may continue to price growth expectations that no longer reflect household reality, increasing the risk of abrupt repricing when the discrepancy becomes undeniable. From a macro-financial perspective, this misalignment increases systemic risk. Consumer-facing sectors experience margin compression as volume growth becomes harder to sustain without aggressive discounting or financing incentives. Small and medium-sized enterprises, which are more sensitive to demand fluctuations, face rising stress earlier than large corporations, yet their struggles are underrepresented in aggregate data. Regional economic disparities widen as areas with higher concentrations of low-wage or service employment feel the slowdown first. These localized stresses accumulate into national weakness that appears suddenly only because it was not properly measured earlier. The policy implications are significant. Monetary and fiscal authorities rely on headline indicators to assess slack, inflationary pressure, and the appropriate stance of intervention. When those indicators understate labor market deterioration, policy remains tighter for longer than underlying conditions warrant. This exacerbates income stress and accelerates the shift toward debt reliance. Conversely, premature declarations of economic strength reduce the political urgency for targeted support measures that could stabilize household finance. And says before conditions worsen. The central risk is not that the data is wrong, but that it is incomplete in ways that matter most at this stage of the cycle. Employment quantity without employment quality provides a false sense of security. Participation without income stability obscures vulnerability. Spending without regard to financing masks fragility. Together, these distortions allow a recessionary process to unfold quietly, gaining momentum while remaining officially unacknowledged. By the time headline job losses emerge clearly, the contraction in consumption and confidence is already well underway. Households have adjusted behavior, businesses have cut back investment, and credit conditions have tightened. At that point, the narrative shifts abruptly from resilience to concern, even though the underlying deterioration began much earlier. This is the defining danger of relying on headline economic indicators in the current environment. They confirm recessions only after they are already deeply embedded. leaving policymakers, markets, and households reacting to outcomes rather than managing risks proactively. Consumer spending in the United States continues to register as resilient in headline data, but the composition of that resilience reveals a structural weakness that carries significant macrofinancial risk. What appears as sustained demand is increasingly a function of balance sheet drawdown and debt expansion rather than income-driven economic momentum. This distinction is critical. Consumption supported by rising leverage can temporarily stabilize growth indicators, but it does so by transferring stress forward in time. The longer this dynamic persists, the more abrupt and destabilizing the eventual adjustment becomes. Current data patterns indicate that this process is not a marginal phenomenon but a central feature of the present economic landscape. The exhaustion of excess savings accumulated during earlier phases of fiscal stimulus has fundamentally altered household financial behavior. Those buffers once allowed consumers to absorb higher prices without immediately cutting back spending. That phase has ended. Savings rates have fallen toward historical lows, and for many households, liquid reserves are no longer sufficient to offset rising living costs or income volatility. In this environment, debt has become the primary mechanism through which consumption is maintained. This shift is visible across multiple credit channels, including revolving credit, installment loans, and alternative financing arrangements that are designed to smooth short-term cash flow at the expense of longer-term obligations. Credit card balances have risen steadily, not merely in nominal terms but as a share of disposable income. This increase is not driven by discretionary consumption alone but by everyday expenses such as food, utilities, insurance, and transportation. When essential spending is increasingly financed through high-interest credit, it signals a breakdown in the alignment between income and cost structures. Delinquency rates, while not yet at crisis levels, are trending upward, particularly among lower and middle-income cohorts. These early-stage stress indicators often precede broader credit tightening as lenders adjust risk assessments in response to deteriorating borrower profiles. Buy now pay later usage has expanded rapidly, reflecting both consumer demand for flexibility and retailer incentives to preserve sales volumes. While these instruments are often marketed as benign alternatives to traditional credit, their proliferation underscores the extent to which households are struggling to fund consumption through current income. The fragmentation of debt across multiple platforms can obscure aggregate exposure, delaying recognition of systemic stress. From a macro perspective, this dispersion does not reduce risk. It complicates monitoring and increases the likelihood of sudden corrections once constraints become binding. The fragility of debt-supported consumption lies in its sensitivity to changes in credit availability and pricing. Unlike income-driven spending, which adjusts gradually with labor market conditions, leveraged consumption can contract sharply when lenders tighten standards or when borrowers reach saturation points. Credit limits are not elastic, and once they are reached, households are forced to retrench regardless of underlying demand. This creates a nonlinear risk profile for consumption, where stability persists until it does not, followed by a rapid and disproportionate decline. Official economic data captures the volume of transactions, but not the balance sheet stress underlying them. Retail sales figures record spending regardless of whether it is funded by wages, savings, or debt. As a result, policymakers and markets observe continued activity and infer economic strength, even as the financial position of households deteriorates. This disconnect delays corrective responses and increases the probability that interventions arrive after conditions have already worsened. The economy appears stable in aggregate while fragility accumulates at the micro level. The reliance on debt to sustain consumption also has implications for monetary policy transmission. Higher interest rates, intended to cool demand, disproportionately affect households already dependent on credit. As interest expenses rise, a growing share of income is diverted toward debt service, further weakening purchasing power. This creates a feedback loop in which policy tightening exacerbates the very income pressures that drive borrowing, increasing vulnerability without immediately reducing headline spending. The lag between rate hikes and consumption adjustment can lead to misinterpretation of policy effectiveness. From a distributional standpoint, debt-driven consumption amplifies inequality. Higher-income households with greater access to savings and lower borrowing costs are less exposed to rising interest rates and credit constraints. Lower-income households, which account for a significant share of marginal consumption, face higher rates, tighter limits, and greater income volatility. As their capacity to borrow diminishes, aggregate demand weakens disproportionately, even if higher-income spending remains stable. This asymmetry contributes to sudden inflection points in consumption data that are difficult to anticipate using traditional indicators. The corporate sector is not insulated from these dynamics. Firms benefiting from steady sales volumes may misjudge the durability of demand, maintaining production and inventory levels that become unsustainable once consumer credit tightens. This misalignment increases the risk of abrupt inventory corrections, margin compression, and layoffs, reinforcing the downturn. Credit-supported consumption thus masks not only household stress, but also emerging vulnerabilities in corporate planning and investment. Financial institutions, while currently well-capitalized, face longer-term exposure to this trend. Rising consumer leverage at high interest rates increases default risk, particularly if labor market conditions soften. While losses may initially appear manageable, the concentration of stress in specific borrower segments can lead to targeted tightening that spills over into broader credit availability. This dynamic reinforces the fragility of consumption and accelerates retrenchment once it begins. The longer consumption remains propped up by leverage rather than income growth, the more severe the eventual adjustment must be to restore balance. Households cannot indefinitely increase debt relative to income without encountering constraints. When those constraints bind, spending reductions are often abrupt and widespread, affecting sectors that previously appeared resilient. This transition is rarely smooth because it involves simultaneous deleveraging across millions of households, amplifying macroeconomic effects. The current environment is characterized by a narrowing margin for error. Policymakers face the challenge of interpreting data that reflects activity without sustainability. Markets price near-term stability while underestimating the risk embedded in household balance sheets. Consumers themselves are adapting through incremental borrowing, masking stress until options are exhausted. This combination creates the conditions for a delayed but sharper correction. The central risk is not that consumption will weaken, but that it will weaken suddenly after an extended period of apparent stability. When that occurs, the narrative will shift rapidly from resilience to concern, even though the underlying deterioration has been visible in credit data for some time. Debt-supported consumption does not fail gradually, it reaches a threshold and then reverses. In the present cycle, that threshold is approaching, shaped by depleted savings, rising interest costs, and constrained income growth. This dynamic transforms consumption from a stabilizing force into a source of systemic vulnerability. It sustains growth readings today while increasing the magnitude of tomorrow's adjustment. Recognizing this distinction is essential for understanding why current economic data may underestimate downside risk. The economy is not being supported by momentum, but by leverage. When leverage becomes the primary driver of demand, stability is an illusion, and the eventual correction is not a question of if, but of how abruptly and how broadly it unfolds. Corporate behavior is often the most reliable leading indicator in any advanced economy because it reflects forward-looking assessments made under conditions of real financial exposure. Unlike households, which may smooth consumption temporarily through credit, or governments, which can frame outcomes through statistical aggregation, firms must commit capital today based on expectations about demand, costs, and financing conditions tomorrow. The current divergence between official growth narratives and observable corporate behavior therefore carries significant analytical weight. While headline GDP figures continue to suggest expansion, the internal decisions of businesses across sectors increasingly point toward caution, retrenchment, and risk aversion that are inconsistent with the picture of durable economic momentum. Hiring patterns provide the first clear signal. Aggregate employment data still shows net job creation, but beneath that surface, firms are slowing the pace of hiring materially. Vacancy postings have declined, recruitment cycles are lengthening, and many companies are choosing not to replace departing workers. This form of labor adjustment does not immediately register as job losses, yet it reflects a deliberate effort to limit future cost growth amid uncertainty. The shift is particularly evident in white-collar roles, professional services, and technology-adjacent sectors that were previously engines of wage growth. Even in industries still reporting revenue stability, management teams are signaling that incremental demand no longer justifies workforce expansion. This behavior reflects not confidence, but caution about the sustainability of current order flows. Capital expenditure trends reinforce this message. Firms are increasingly deferring or scaling back investment in new equipment, capacity expansion, and long-term projects. While some of this retrenchment is attributed to higher interest rates, the more important factor is demand visibility. Capital investment is not merely a function of financing cost, it is a judgment about future utilization. When companies hesitate to commit capital despite still strong cash flows, it indicates concern that future demand may not be sufficient to justify irreversible investment. This dynamic is now visible across manufacturing, logistics, commercial real estate, and even segments of the energy transition, where timelines are being stretched and projects reprioritized rather than canceled outright. Such behavior reflects uncertainty, not optimism. Earnings reports further illustrate the nature of the current cycle. Corporate profitability, where it exists, is increasingly driven by cost containment rather than revenue growth. Margin preservation has become the dominant management objective, achieved through headcount discipline, reduced discretionary spending, and operational efficiencies. While these measures can support earnings in the short term, they do not represent organic expansion. Historically, late cycle periods are characterized by precisely this pattern. Revenue growth slows, pricing power weakens, and firms turn inward to protect margins. The reliance on cost cutting rather than top line expansion suggests that companies are preparing for a less supportive demand environment ahead. Inventory behavior offers another window into corporate expectations. Rather than building inventories in anticipation of stronger sales, many firms are actively managing stock levels conservatively. Inventory to sales ratios are being kept tight, and supply chain flexibility is being prioritized over scale. This defensive posture reflects concern about demand volatility and the risk of being caught with excess stock in a downturn. In previous cycles, inventory accumulation has often preceded growth accelerations. The current emphasis on lean inventories instead aligns with expectations of slower turnover and increased price sensitivity among consumers and business clients. Financing conditions, particularly for smaller and mid-sized firms, add further context. While large corporations with access to capital markets can still secure funding, albeit at higher costs, smaller enterprises are encountering tighter credit standards and higher effective borrowing rates. Bank lending surveys and anecdotal reports consistently indicate reduced willingness to extend credit, especially for expansionary purposes. This tightening occurs even as official financial conditions indices remain relatively benign. The discrepancy reflects the difference between system-level liquidity and its distribution. For firms operating closer to the margin, access to financing has already become a constraint on growth plans. Corporate cash management strategies underscore the same theme. Firms are prioritizing liquidity, building cash buffers, and extending debt maturities where possible. Share buybacks and dividend increases, while still present, are increasingly selective and justified as capital return rather than expressions of confidence in future growth. In parallel, merger and acquisition activity has slowed, not because opportunities are absent, but because valuation uncertainty and financing costs complicate deal economics. When corporate leaders choose optionality over expansion, they are signaling that the balance of risks has shifted. The importance of corporate caution lies in its implicati. Ons for future economic dynamics, business investment is a critical driver of productivity growth, wage expansion, and long-term output. When firms pull back simultaneously, the effects compound. Slower investment today translates into weaker capacity, lower productivity gains, and constrained wage growth tomorrow. These effects do not appear immediately in GDP statistics, which are backward-looking and often revised, but they shape the trajectory of the economy over subsequent quarters and years. The apparent resilience in aggregate data thus masks a weakening foundation. This disconnect between official indicators and corporate behavior is not unprecedented. In prior cycles, similar divergences have emerged during transitions from expansion to slowdown. Official data anchored in historical performance continues to reflect momentum even as forward-looking indicators deteriorate. Corporate decision-makers exposed to real-time order books, customer behavior, and financing conditions adjust earlier. When the divergence persists, historical experience suggests that macro data eventually converges toward the corporate signal, not the other way around. The psychological dimension is also significant. Corporate leaders are not merely reacting to current conditions, they are shaping expectations within their organizations and supply chains. Hiring freezes, cautious guidance, and conservative investment plans influence employee behavior, supplier confidence, and regional economic activity. These second-order effects reinforce the slowdown, creating a self-referential cycle of caution. Once established, this mindset is difficult to reverse quickly, even if conditions stabilize. Importantly, the current environment amplifies these dynamics because financing costs are structurally higher than in the previous decade. In a low-rate world, firms could afford to take risks, refinance easily, and absorb temporary misjudgments. In a higher-rate environment, errors are more costly, and caution becomes rational. This structural shift means that corporate retrenchment carries more weight than in past periods of mild uncertainty. The margin for error has narrowed, and management behavior reflects that reality. The divergence between corporate caution and official optimism therefore represents more than a statistical anomaly. It signals a turning point in expectations that will shape employment, investment, and income growth going forward. When businesses consistently act as though growth is fragile despite positive headline data, it suggests that underlying conditions are weaker than reported. The economy does not slow because data changes because behavior does. In this context, corporate balance sheets and strategic decisions offer a clearer window into the future than aggregated indicators. As this divergence persists, the risk is not sudden collapse but gradual erosion. Employment growth may slow before turning negative. Wage gains may stagnate rather than fall outright. Investment may decline incrementally rather than abruptly. These changes are less visible but no less consequential. By the time official data reflects contraction, the adjustment in corporate behavior will already have been underway for some time. The warning is not hidden in abstract models, but visible in the quiet, consistent caution of firms preparing for conditions that headline narratives have yet to acknowledge.